Imagine it's February 13th, 1986. You are a 38-year-old dentist living in Houston, Texas, United States. Your clinic sits in a low beige strip mall off a 6-lane road lined with fresh asphalt, new signs, and cranes that never seem to stop moving. You have a 3-bedroom house in the suburbs, 2 children, a retirement account at a local bank, and a mortgage that feels manageable because everyone around you says the city is still growing. Each morning you drive past shining office towers, half-built apartment blocks, and giant billboards promising luxury space for lease, and it all looks like proof that the future has already arrived. Your patients work in oil services, construction, title firms, architecture offices, and banks, and their checks clear, their jokes are easy, and nobody talks as if the ground under Houston could ever crack. On weekends, you and your wife talk about buying a small office condo as an investment. Because prices rose last year, your banker says commercial property is solid, and it feels reckless not to join in. If you have ever wondered why banking crises so often begin in places that do not look dangerous at all, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened before. And once you see it, you cannot unsee it. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Then the calls change. A patient cancels because his engineering firm cut staff. Another asks for a payment plan. The builder who promised to lease the empty space next door disappears. Oil prices weaken, construction slows, and the towers that looked like monuments start to feel like mirrors, reflecting back a boom built on borrowed confidence. Within a few years, Houston office vacancy climbs, home prices fall, foreclosures spread, and the banking system that fed the frenzy begins to break under the weight of its own loans. That is the story of commercial real estate crises. They rarely begin with panic in the street. They begin in spreadsheets, appraisals, refinancing calendars, and quiet assumptions about rent, demand, and interest rates. They begin when banks lend against buildings whose value depends on tomorrow looking a lot like yesterday. And when tomorrow changes, the loan stays put while the collateral beneath it melts. This video is about the banking crisis that has already started in commercial real estate, not as a prediction, but as a historical pattern. We are going to look at what happened in Texas in the 1980s, in Japan in the 1990s, in community banks across Georgia and Florida after 2008, and in other countries that learned the same lesson the hard way. Different flags, different decades, the same hidden machinery. Because history shows that when banks become too dependent on commercial property, trouble does not arrive like lightning. It spreads like water inside a wall. By the time the paint blisters, the damage has been there for a long time. Before we go further, there is something important to understand. Commercial real estate is not priced like a family home. A house can still feel valuable because a family wants to live there. An office tower, shopping center, hotel, or apartment block is valued mainly by the cash it can produce. Rent comes in, expenses go out, and investors place a price on that stream of income. A simple way to think about it is this. The building is a machine, and the price is based on what the machine is expected to earn. Banks lend against that machine. They look at occupancy, rents, refinancing costs, and the value of the property if they ever need to seize it. When times are easy, these numbers can look almost magical. Vacancies seem temporary. Interest rates seem low enough. Tenants seem stable. Appraisals rise. More loans are made. More buildings are built. The whole system starts to resemble a bridge held up not by steel, but by optimism painted to look like steel. Then something shifts. Sometimes it is an oil crash. Sometimes it is higher interest rates. Sometimes it is a recession, remote work, or credit freeze. The rent roll weakens. Tenants leave. New leases come in at lower prices. Refinancing gets harder. The property is suddenly worth far less, but the loan against it has not shrunk. This is how a real estate problem becomes a banking problem. And this is the part most people miss. Banks do not always recognize those losses right away. They extend terms. They modify loans. They hope time will heal a wound that is still bleeding. The crisis does not move like a fire alarm. It moves like a slow elevator with a snapped cable. Quiet at first, then impossible to stop. That is why commercial real estate banking crises can feel delayed, confusing, and strangely calm until they are not. This brings us directly to Texas. In the early 1980s, the Southwest looked unstoppable. Oil money was flowing, population was rising, and banks were hungry for growth. As energy markets weakened, many banks did not pull back. They pivoted. They poured money into commercial real estate instead, especially office buildings, construction projects, and land development. It was like a casino changing games without changing its gamblers. The appetite for risk remained. Only the wallpaper changed. From 1980 through 1994, Texas suffered 599 bank failures with $60.2 billion in failed bank assets. Between 1980 and 1989 alone, 425 Texas commercial banks failed, including 9 of the state's 10 largest bank holding companies. In 1988, 175 Texas banks failed with $47.3 billion in assets. In 1989, another 134 failed with 23.2 billion. Those are not small cracks. That is a structural collapse. Look at what happened underneath. From 1980 to 1987, office vacancy rates in Dallas jumped from 8% to 28%. In Houston, they rose from 11% to 31%. In Oklahoma City, from 2% to 28%. Banks kept financing projects even as empty space spread. Construction continued while the market was already gasping for air. It was as if builders were still pouring concrete into a bucket with no bottom. Why did they do it? Partly because fee income looked good in the short term. Partly because competition pushed standards down. Partly because recent price gains made bad decisions look smart. When values rise, weakness hides easily. A risky loan can appear sound for a while if the building next door just sold at a higher price. But price is not the same as strength. Sometimes price is just the last stage of denial. Ordinary people felt the pain long before they understood the mechanism. By the end of September 1986, 743,000 Texans were unemployed. Houston's unemployment rate reached 10.5%. Texas lost around 250,000 jobs in 1986 alone, and almost 100,000 of them were in construction. Families left the state. Small businesses lost customers. Partially empty subdivisions became magnets for neglect and vandalism. In Houston, median home resale prices fell 23% between 1983 and 1988. In some communities, foreclosure rates went above 60%. Notice what made this so destructive. The loans were not just large, they were concentrated. Banks that eventually failed had much heavier commercial real estate exposure than banks that survived. Across the 1980s and early 1990s, failed banks kept pushing more of their balance sheets into commercial property. By 1993, commercial real estate loans at banks that later failed were close to 30% of total assets, up from about 6% in 1980. At non-failed banks, that figure rose only to about 11%. That gap matters. In a storm, a ship with too much weight on one side does not need a giant wave. A steady lean is enough. And when loans finally went bad, the damage was brutal. In 1991, 8.2% of commercial real estate loans were non-performing or in foreclosure. In 1992, net charge-offs on commercial real estate loans peaked at 2.1%. An FDIC review found an average decline in collateral value of 54% across a sample of failed loan assets. Nearly half lost at least 50% of their original value. That means the building the bank thought was a shield had turned into paper armor. Texas was not a strange exception. It was a warning. Commercial real estate does not have to collapse everywhere at once to crush lenders. It only has to collapse where lending is concentrated. And refinancing depends on conditions that no longer exist. Here is something I want you to think about before we go further. When a bank says a loan is still performing, does that mean the building is healthy? Or does it only mean the borrower has not missed the payment yet? Drop your answer in the comments. Seriously. Because what I am about to show you next is the part of this story that most people never hear. And it changes everything. This leads to the second part of this story. Japan in the late 1980s looked to many observers like a machine that could not slow down. Land prices soared. Stocks surged. Credit expanded. Urban real estate prices quadrupled between September 1985 and September 1990. At the peak, the country's property market seemed almost untouchable. Land was treated not just as an asset, but as a kind of financial oxygen. If you owned land, you had collateral. If you had collateral, you could borrow. If you could borrow, you could keep going. The system fed itself like a snake swallowing its own tail. Japanese financial institutions across the board became heavily exposed to real estate-related industries. Housing loan companies known as Jusen shifted toward lending to real estate developers, even though many had little true expertise in commercial lending. Banks leaned on land values as if they were bedrock. But land values are not bedrock. They are weather. And weather changes. After the bubble burst, Japanese commercial real estate prices fell dramatically. One Federal Reserve study described a 70% decline in Japanese commercial real estate prices from their peak in 1990. A BIS study found that urban real estate prices plunged by 80% to pre-bubble levels by 1999. That collapse shredded the value of collateral across the banking system. Loans that had seemed secure became weak. Weak loans became non-performing. Non-performing loans piled up year after year like snow on a roof no one wanted to inspect. Estimates later suggested the bad loan problem rose to 6 to 8% of Japan's GDP. From April 1992 to March 2000, the country spent about 86 trillion yen, roughly 17% of GDP, dealing with non-performing loans. Important failures arrived in waves. Tokyo Kiowa and Enzen credit cooperatives failed on December 9, 1994. Cosmo Credit Cooperative failed in July 1995. Then came the more famous shock in November 1997 when Sanyo Securities failed, Hokkaido Takushoku Bank collapsed, and Yamaichi Securities shut its doors. But again, the human story matters most. This was not only a story about bank balance sheets in Tokyo. It was a story about small firms that could no longer roll over loans, shopkeepers who saw spending weaken, workers whose bonuses shrank, younger families who entered adulthood under a sky of slow growth, and a country that spent years trapped between denial and cleanup. The term many people later used was zombie banks. That means banks that are alive enough to keep operating, but too damaged to lend properly and too unwilling to recognize losses fast enough to heal. And zombie banks create zombie economies, places where capital gets stuck in weak projects, while stronger new ventures struggle to get oxygen. Now here is where it gets interesting. Japan shows that a commercial real estate banking crisis does not always look like a fast explosion. Sometimes it looks like a long winter. The danger is not only collapse, the danger is paralysis. Because once banks are tied to land values that no longer make sense, every decision becomes political, painful, and delayed. Write down the loss, and capital disappears. Hide the loss, and growth disappears. Either way, someone pays. The core mechanism was the same as Texas, but with a different rhythm. In Texas, the damage was dramatic and regional. In Japan, it became national and drawn out. Yet in both cases, banks had lent heavily against assets whose value depended on a boom continuing. When the boom died, the buildings remained, the debt remained, and the illusion of safety vanished. Collapse is not always a falling tree. Sometimes it is a forest that stops growing. And this is where history gets uncomfortable. Many people still think the crisis of 2008 was mostly about suburban houses in America. But look closer and a second story appears, quieter, and in some places even more lethal for banks. It unfolded in community and regional lenders that stuffed themselves with commercial real estate and construction loans, strip malls, land development, condo towers, small office parks, hotel projects, raw land on the edge of towns that were expected to grow forever. Between 2008 and 2013, Georgia saw 87 bank failures, and Florida saw 70. Those numbers were far above much of the rest of the country. In the broader 6th Federal Reserve District, Georgia and Florida dominated the failure map, while the remaining states in the district reported only 14 failures combined. In Georgia, the failure rate among newer banks hit 42%. In Florida, 19%. These were not giant Wall Street institutions. Many were local lenders that knew every road in town and still managed to drive straight into the ditch. And what loaded the gun was concentration. FDIC research later found that failed banks in the 2008 to 2013 crisis were even more heavily concentrated in commercial real estate, especially construction and development loans, than failed banks in the earlier crisis. The difference was striking. In the earlier crisis, more than 80% of failed banks had less than 10% of their assets in construction and development loans. In the later crisis, 66% of failed banks had construction and development exposure above 20% of total assets. That is not diversification. That is a bet disguised as a business model. Local communities felt it fast. In markets like Atlanta, Orlando, South Florida, and Tampa, commercial and residential land values fell at least 60% from peak to trough. Single-family permit issuance across the 6th District fell more than 80%. The value of non-residential construction put in place dropped nearly 60%. Half-finished subdivisions sat under weeds. Unleased retail shells stood beside highways like empty movie sets after the cameras had gone home. At more than half of the banks that failed between 2008 and 2013, construction and development loans had the highest delinquency rates in the portfolio. In Georgia, more than 3/4 of failed banks reported construction and development as the worst category at the time of failure. The pattern is almost painfully simple. When the easy credit years arrive, small banks often grow by lending where big banks are less interested or less local. That can look smart, until the local boom turns out to be the entire strategy. What ordinary people experienced was not a television version of crisis. It was a contractor not getting paid, a drywall crew losing work, a restaurant near a building site going quiet, a small business owner being told the credit line would not be renewed because the bank itself was under stress, a town discovering that its prosperity had been built not on permanent demand, but on a chain of refinancing assumptions running through a handful of fragile institutions. And yet even here, the banking system often looked stable right up until it did not. Loans do not default the moment a property becomes weaker. Maturities have dates, covenants have thresholds, appraisals lag, borrowers negotiate, banks delay. The wound stays hidden under the bandage until the refinancing moment arrives. Then suddenly a building worth far less than before needs a new loan in a world with tougher terms. That is when the math stops pretending. This is why commercial real estate crises are so deceptive. They do not just ask, can the borrower pay today? They ask, can the property support the debt when it has to be rolled over tomorrow? In good years, that question sleeps. In bad years, it wakes up everywhere at once. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Now observe what all of these cases have in common. Texas in the 1980s, Japan in the 1990s, Georgia and Florida after 2008. Different countries, different decades, same result. First, easy or abundant credit flows into property. Second, rising values make lenders feel safer than they are. Third, underwriting weakens, because rising prices forgive bad judgment. Fourth, banks become concentrated in one kind of collateral. Fifth, a shock hits. Sixth, rents, occupancy, or refinancing conditions change. Seventh, the building value falls faster than the loan balance. And only after that do the banking problems become visible. The same mechanism, different countries, different decades, same result. The building is not really the asset the bank owns. The bank owns a claim on a future stream of rent and refinancing. If either stream weakens, the value can fall hard. Commercial real estate is less like gold in a vault and more like a theater production that only works if enough people keep buying tickets. When the audience shrinks, the stage is still there, but the numbers no longer sing. And now look at the present pattern. Banks hold about $3 trillion of the roughly $5.9 trillion in outstanding U.S. commercial real estate loans. Office properties remain the weakest part of the market. The FDIC says office vacancy rose from 13.3% to 13.8% in 2024 and reached 15.2% in the top 20 office markets. Across 10 major cities, in-office use averaged only about 48% of pre-pandemic levels as of April 2024. The office loan delinquency rate rose from about 2.4% in February 2023 to about 6.6% in February 2024. At the same time, exposure is uneven. Large banks have seen notable deterioration in performance, but smaller institutions carry heavier concentrations. 30% of community banks were classified as CRE concentrated at the end of 2024. Regional banks with assets between $10 billion and $100 billion had median CRE concentration ratios around 289%. Banks with assets between $1 billion and $10 billion were around 314%. Reuters reported that small banks account for nearly 70% of all commercial real estate loans outstanding. The Mortgage Bankers Association said $957 billion in commercial mortgages mature in 2025, and 24% of office property loans come due this year. That is the maturity wall people keep talking about. It is not a wall of concrete, it is a wall of dates. This does not prove a repeat. History never photocopies itself perfectly, but it rhymes. And the rhyme is clear. Weak offices, falling values in some markets, heavy concentration in smaller banks, large refinancing needs, and banks still hoping time can repair assets whose economics may have changed for good. When Reuters quoted investors saying some properties are now valued 50 to 75% below their valuations at origination, it echoed an old lesson. A loan can stay on a balance sheet longer than the world that justified it. Who gets hurt first in a commercial real estate banking crisis? Usually not the people who created the structure, usually the people standing closest to it when it starts to shake. The middle manager whose firm stops renewing leases and starts cutting staff, the contractor whose receivables are tied to delayed projects, the retiree whose town depends on local banks for credit and whose savings may be safe on paper while the local economy dries out, the small business owner who did nothing reckless but cannot refinance equipment because the bank has become afraid of everything. Sweden in the early 1990s offers a clean example of this hidden transmission. During the years before the crisis, private borrowing in Sweden rose from 85% to 135% of GDP in just 5 years. Real estate speculation swelled. Then the bubble burst in 1990 and 1991. At the peak of the crisis, bank loans to real estate, or loans backed by real estate, accounted for more than 60% of all bank loan losses. Non-performing and other impaired loans reached 15% of GDP. Sweden's GDP fell by around 6% between 1991 and 1993. The state eventually rescued the system, and the original cost to the government amounted to about 4% of GDP. That relatively successful cleanup is why Sweden is often remembered as a model. But models still have casualties. A banking rescue can stabilize institutions while households and businesses still pass through a recession that feels like walking on broken glass. Credit disappears. Companies fail, unemployment rises, the repair of bank balance sheets does not instantly repair the social fabric. Ireland after 2008 tells the same truth in a different accent. A credit-fueled property bubble, both residential and commercial, pushed banks into deep trouble. The government entered an EU IMF support program worth 85 billion euros. That meant austerity, public sector pay cuts, further banking stress tests, and more capital injections. Years later, the wreckage was still visible. Between 2011 and 2016, Ireland's housing stock increased by only about 8,800 homes, compared with more than 500,000 added in the first decade of the 2000s. Non-performing loans in the Irish retail banking system fell from 85 billion euros in 2013 to about 25 billion by the end of 2017. But that decline came after enormous pain. What ordinary people experienced in Ireland was not an abstract chart. It was arrears, restructuring, emigration, and years of thin opportunity. By mid-2018, about 46,000 owner-occupier mortgage accounts were more than 90 days in arrears. 1 in 6 owner-occupier loans had undergone some form of restructuring. That is what a property banking crisis looks like when it moves from the tower to the kitchen table. And there is another uncomfortable truth. Not everyone loses equally. The people with diversified income, patient capital, long funding, and room to wait often come through far better than those living month to month. Distressed investors arrive when owners are exhausted. Large institutions with stronger balance sheets can buy assets from forced sellers. Cash becomes a life raft in a storm that drowns leverage. The crisis is rarely democratic. It is selective. It punishes concentration and fragility, then rewards those who can buy from the wreckage. That is why commercial real estate banking crises feel so unfair. The gains in the boom are celebrated as broad prosperity. The losses in the bust get funneled downward through layoffs, credit contraction, and public support. The tower may be empty, but the bill still finds its way to the street. And if you want a modern example of how these tensions surface, look at what happened when New York Community Bancorp shocked investors in early 2024. After its January 30th earnings release, its shares plunged by about 60% in a matter of days. Reuters reported that banks such as NYCB, Valley National, and Ocean First had commercial real estate holdings greater than 300% of risk-based capital, with ratios around 468%, 479%, and 447%. That 300% line matters because regulators have long treated it as a sign of serious concentration risk. It does not mean failure is automatic. It means the margin for error is thinner than it looks. What makes this episode so revealing is that the losses were not coming from some mysterious corner of finance. They were tied to the same old ingredients: higher rates, weaker property values, and borrowers struggling to refinance in a market that no longer supported yesterday's assumptions. Reuters also noted that the default rate on New York rent-stabilized housing loans rose from 0.32% in April of 2020 to 4.93% in December 2023. In other words, the strain was moving through ordinary buildings, ordinary tenants, and ordinary lenders. Not a cinematic crash, a pressure system. The kind that builds quietly until one institution reports the pain, and suddenly everyone remembers how much of the system sits on top of commercial property. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. So what do the survivors do differently in these episodes? Not the speculators who got lucky for a year, not the promoters who exited early, the real survivors, the people and institutions that came through with less damage. The historical record shows that those who came through these periods largely shared a few characteristics. First, they respected cash flow more than appraisals. They did not confuse a rising paper value with a durable income stream. Surviving lenders looked harder at whether rent could actually support the debt. Surviving households and businesses tended to avoid betting their future on assets that needed perfect conditions to stay afloat. They understood that a glossy valuation is a photograph, not a foundation. Second, they avoided concentration. The failed banks in the 1980s and early 1990s loaded up on commercial real estate until it approached 30% of total assets. Non-failed banks were much lower. In the 2008 to 2013 crisis, the failed banks were disproportionately packed with construction and development loans. Survivors were not always smarter in every way. Often, they were simply less one-sided. They did not build a house with only one wall. Third, they faced losses earlier. Sweden's eventual recovery owed something to the fact that it moved more decisively than countries that spent years pretending. Japan showed the opposite danger. Delay can turn a crisis into a long stagnation. The building may still stand, but the balance sheet becomes a haunted house full of rooms no one wants to open. Institutions that raise capital, sell bad assets, and admit reality early often look weakest in the moment and strongest a few years later. Fourth, the people who survived best usually had time on their side. Fixed-rate debt, longer maturities, more liquidity, and less dependency on short-term refinancing all mattered. In commercial real estate, time is oxygen. If you must refinance in the middle of the storm, the market names your price. If you can wait, you at least have a choice. This is not financial advice, it is historical pattern recognition. The winners in these episodes were rarely the loudest people in the room. They were the ones who understood that leverage is a fair-weather friend, that concentration can look efficient right before it looks fatal, and that the most dangerous moment in a boom is when risk starts to feel normal. History does not reward confidence alone, it rewards structure. Now return to Houston. Imagine that dentist again, the one driving past new towers in February 1986, thinking the city's growth had the permanence of weather. By 1988, the route to work feels different. More lease signs, fewer workers. The office condo you almost bought no longer looks like an opportunity. It looks like a trap you narrowly missed. Patients delay treatment. Your retirement account feels less certain. The bank branch is still open, but confidence is not. The city did not collapse in a single afternoon. It hollowed out in layers like wood eaten from the inside. That is the final lesson. Banking crises tied to commercial real estate do not begin when a bank fails. They begin when lenders treat rising property values as proof of safety, when entire business models lean on refinancing instead of resilience, and when concentration hides behind the comforting language of local expertise. History shows the same sequence again and again. Credit expands, buildings multiply, risk feels managed. Then demand shifts, rates rise, or growth slows, and the collateral that once looked solid becomes slippery. The visible banking problem is only the late chapter. The story starts much earlier. That is why the phrase banking crisis can be misleading. It makes us picture vaults, bank runs, and emergency weekends. But in commercial real estate, the first break often happens in the building itself, in the empty floor, in the weaker lease, in the appraisal that no longer matches reality, in the maturing loan that cannot be refinanced on old terms. The bank is just where the damage finally becomes impossible to hide. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.